Good morning, ladies and gentlemen. Well, nothing new from the risk dial, and as I told you last week, this is going to go on for weeks and months. There's absolutely no way that with these scores, the risk dial will go to risk on, I don't know, for the next 2 or 3 months at least. So, not a lot to be learnt from this. But I think that what we need to do is have a look at where real rates are and try to figure out what is ahead that way. Now, as you know, I've been a proponent that real rates will remain high. And if you have a look at this chart of real rates, what you notice is that we are now at the same level or higher than we were before the Trump Liberation Day. Real rates are just not coming down. They tried to go down and then they went back up, and now we are again over 2% because this is May. First, on the second, we went 5-6 basis points, so we're at 205, 206. We seem to be stuck in this area, which basically is saying that you are not going to get any help in your portfolio from bond rates until and unless you get a real whoosh down in economic activity, which is reflected in the data. Temp premium remains stubbornly high. This is what you had, sort of a little bit of panic, and it's back up. It's back up to 60 basis points at the moment. So you're not going to get any help from duration until you get a real whoosh down in economic activity. Your portfolio is at the moment completely held hostage by bonds not being able to move. And when I say bonds, I mean longer duration, 10 years plus. So this is a chart of TIP. And really, I think it's becoming clear that we've spent over 2 years, 2.5 years in this range. And this range, as I showed you in the previous chart of real rates, is a high range. This is as high as real rates have been since the great financial crisis. So what does it tell you? It tells you that you really can expect that the market is beginning to discount recession only when it starts closing weeks above 110.81. Everything that it's been done, and really you can say that it's 111.24 the level, but it really makes no difference. I've had this line in here for weeks and weeks and months, I think ever since the September level. You won't get a recession until real rates start going much, much lower. And no, it's actually the other way round. The recession will be signaled by real rates going down. So when the market becomes convinced that we are having a recession, real rates will fall, will fall way under the previous highs. And therefore, that is what I'm looking at to give me an idea. Even TIPZ, which is the longer run, the level here is around 54.34. You really have to have longer term real rates coming down for a clear recession signal that the market is beginning to expect recession to hit. I think in Europe you're going to get much the same kind of response as in the US, and I don't think a lot is going to happen. If you see the Schatz anywhere near 188 next week, I think the odds are that you buy it. Fives, much the same as in the US. Anything around the 217 area, I think, is a buy. And 10s and 30s, much less so. the bund keeps on swinging around this 252 area, and it's basically where it likes to be for the time being. But I think eventually it'll start going higher, and the yield curve will get steeper in Europe as well. I don't think the timing is now, but what I do think is that it's a much better bet to be long of the US than to be long of Germany. So here we have twos, US, Germany. And let me qualify that statement. I think for next week, it's better to be long of the US than Germany. Twos are actually very much stuck in a range, but I don't think that that is what is going to move until and unless we get a recession in the US. When we do, of course, the US is going to cut by a lot, and a lot more than the ECB will cut, and you will get that down here in the 130s without any problem. But for the time being, that is not what the charts show. The charts show that the probability is going to be that this remains in a very tight range. Fives are discounting more of a probability of a recession in the US, as you can see. And tens are really not showing you very much at all. They've remained around this 200-day moving average. I still think eventually they will go down to below these levels, to around this 105 area, and the dollar will be weak. But I don't think it's going to happen anytime soon. So to me, the trade is actually to buy the US short end, twos to fives, just after the 3-year auction, which is on Monday. So in that window between Monday afternoon to Tuesday morning midday, because after the 10-year note, I would have thought they will have cheapened the market enough, and then on Wednesday we have the FOMC, and I'm convinced that Powell will somehow manage to be dovish, and you'll get a rally in the twos and fives mostly. I haven't changed my view about the dollar. I think it's in a period of consolidation, and I think it's in a period of consolidation for quite some while, which basically tells me that until you start getting the potentially recessionary data, the dollar tries to do better. It's trading technically very well indeed. This 139 level has been rock solid. What I think is that it will stop people out and go above it, and probably go to this kind of level, 101.05, and stop most people out. But there I think it's likely to turn around. So let's have a look at it against the euro. I would have thought that 111.50 to 111.80 is the level that it's going to try to trade, and that is to me a level where you want to be buying call spreads. And really the interesting one is the yen after the Bank of Japan, because the Bank of Japan was far more dovish than anyone thought, and the euro yen is back at 164.20. It looks to me like he wants to break these levels and go back up to around the 165.5, and that would make perfect sense for the time being, which tells you that if the yen manages to break this 146 area, it's going to trade somewhere around the 148 and stop people out, and then it's going to slowly return down when there's a new phase of dollar weakness. So you're not going to get a new phase of dollar weakness for another couple of weeks, which really matches with what I think is going to happen to the data, and that the data is only going to start getting weak in 2 to 4 weeks' time. Commodities are weak, but they are contained in their weakness. They are bouncing trading technically very well off the 2070 level. I don't expect it to hold. I expect this 1977 level to provide the opportunity to get long of commodities, and so I'm not buying until that level is reached. But the fact that commodities are so weak is another reason why I think that Powell has absolutely no mileage in being anything more dovish than neutral. So, and that really gives you an opportunity to get long of short rates before Powell starts speaking, because I think the odds are overwhelming that he will be interpreted as dovish. Gold, I think, is very clear at the moment, and I think it's really shot its bolt for now. It needs a little bit of consolidation, but the levels have become very, very clear. We have not managed to close above 3,347 for many days, a week plus. So unless you see a close above there, you still have to be looking for continued downside to around at least this 31.25 area, or possibly all the way down here to below 3,000. To me, gold for the time being has completely shot its bolt. I don't see why gold GSG should keep on going up. That to me doesn't make a lot of sense. What inflation are we worried about? And if gold against tip remains stable, and there is no reason to look for, to prefer tips at the moment, but, just a range trade, I just don't see why gold GSG will continue to go higher. I really would like to see that correct, and the only way it's going to correct in a period when GSG is not going up is if gold comes down. So that's what I would like to see. Might be wishful thinking, because I would want to buy gold once it's corrected. Once it's corrected to these areas, I think I would be a much better buyer of gold, or I could again go into gold, because I've been selling it for quite some time. I promised that I would start giving you my technical levels on Bitcoin, and that technical level is very, very clear. 91,600. While it's above, it's risk on, as it were. When below, it's liquidation. I think that the very fact that Bitcoin is trading so poorly compared to its other equivalent like MSTR just tells you that it's not a real strong risk on. I think that if you see 91,600, you definitely want to be looking for a bit of a bounce. But look, we are now below Friday, and that to me tells me that there is no real enthusiasm for risk on in general. So we are not in a very strong trending risk on period like we were here a couple of weeks ago. We are much, much more subdued. And that tells me that something like then GLD against EBIT, and you can see how GLD has topped against Bitcoin, is not going to go much further than these kinds of levels. The fact that Bitcoin is so uninspiring at the moment says that it's not strong risk on. I want to start equities with the VIX. This is going to be a great time to start buying options. When we start hitting 2060, and I know the difference is not huge between the price here and here, but it is quite significant in the price of an option. That to me is going to be a great time to start buying calendar put spreads and all sorts of option protection for your portfolio. anything 2060 and below down to 1970, I think is going to be a gift or a potential gift in 3 to 4 weeks time. So be very aware of that level. Clean SPX chart. Now, the fact that I've been saying that I think Powell is going to be dovish, and also the fact that the data, the weak data, is not going to start hitting for another couple of weeks, tells me that, or cannot come for another couple of weeks. I have no idea if the data will be weak or not, but I think the preponderance of the probabilities is that it will be. So what are the levels? Well, it's very clear to me, 56, 62 or 65 is the level that you want to be in options by, because by then, so I think volatility will be at that 2060 area, and we will be trading somewhere around here, the 57.65 area. If we have a look at that area on the 195-minute chart, you will see that it comes in with, it will match with the 200 period moving average, and I think the odds are overwhelming that when we hit there, and by then you know that I will be fully in my options, in my calendar put spreads, the likelihood, the overwhelming likelihood is that we come down and retest this 54.87 area. I don't think it's going to be quick. I don't think it's going to be until the latter part of next week, because I think by Wednesday, Wednesday should be an up day. So maybe we really go up to 58.65. I find that difficult to believe, but you know, I'm certainly not going to exclude it. And that's why I want to do options which expire only after the second half of June, and really sell anything before then at this kind of strike. I think that we have very little likelihood of going below 54.87 in the course of the next 2 or 3 weeks. To me, this 20,392 area is going to be absolutely key in the Nasdaq, and I think we test it. And just like I think that we test the 20,660, so we go up, we test this area, we break it, and then we come back. 20,660 to me is so important in the NDX. If we can close next week through it, then what I've told you for SPX is unlikely to hold in terms of levels. We're going to need to go to the next level up. But I think it's going to be very, very difficult for us to close above here. If we close the week above here, then there's something going on that I'm not appreciating. So I would prefer to see a break and then we come back towards the latter half of next week. But also the implication of 20,660 on the NDX is that you want to be longer volatility there, right? Because whatever happens, either we're going to go make new all-time highs, or we're going to come down and retest this area here around 17,600. And you can see how quickly we did it there. I don't see why, you know, this should happen again. This is August of last year. We could come and do it very, very quickly, and we have the 200 period moving average up here, so it could be just as quick. So it could be that the data hits in 3 weeks' time and we do that kind of movement. But what I'm saying, at this level, you really, really want to have an optionality position, because either we're going to go straight up or we're going to go straight down. Funny how things seem to be lining up in the Nikkei as well. I think this level, which is, let's call it 37,900, is going to be absolutely crucial. If all we've done in the US is test those upper levels that I showed you and we can't close above them, and all we've done in the Nikkei is test this level and we can't close the week above it, I think the picture becomes much clearer for the week after, that rather the weeks after, that the probabilities greatly increase that we are going to retest lower levels. But we will see. We've had a very, very strong bounce, which, in bear markets is not to be, discounted ever. You can see what happened here. We still had this move down. So I think that you want optionality at these levels. So you want optionality at the SPX level, and let's have a look there. So you want optionality at this level. You want 57.65. You want a lot of optionality there. VIX, as I showed you, you want optionality here at 2060. NQ, you want optionality at 20,600, 20,400 to 600. You want a lot of optionality there. So everything that I've showed you says that you want a lot of optionality in equities, and that rather than carrying outright positions, you should really transfer those to options. So with that in summary, things are becoming a lot clearer about levels in the stocks, and you want to transfer the outright positions into options, and all done at the VIX level of around the 2060 area. Otherwise, I think the only trade is going to be long of 2s and 5s before the Fed, and we'll do that probably on Tuesday. Thank you very much indeed, and have a wonderful weekend.